Everyone's watching Nvidia and OpenAI fight for dominance in artificial intelligence. But here's what the headlines are missing. The real story isn't about who wins the competition, it's about how all the players have become tangled up in a circular financing loop where the money just keeps spinning between them. Picture it like this. Nvidia makes the chips. CoreWeave buys the chips and leases computing power to AI companies. Nebius is another compute provider doing the same thing. But here's where it gets weird. The venture capital firms backing these companies often have money in all three at the same time. So Nvidia's customers are funded by Nvidia's investors, and the investors profit when their portfolio companies buy more chips from Nvidia. It's a circle. This matters because circular systems are incredibly efficient when they work. Capital flows exactly where demand is. Money gets recycled instantly, and everyone grows together. But circular systems also have a hidden danger. They are stable only as long as every link in the chain remains strong. If just one player stumbles, the whole ecosystem shakes. And right now, the GPU boom is running on the assumption that this circle will keep spinning forever. So what does this circular economy actually look like up close? And should investors be getting nervous about it? That's what we are digging into today. To understand the circular web that's forming right now, you have to go back about 3 years. The AI boom started when ChatGPT launched, and suddenly every venture capital firm on Earth realized that artificial intelligence was going to be genuinely transformative. Billions of dollars flooded into AI startups overnight. But here's the problem nobody anticipated. Every single one of these AI startups needed something you can't just print money and create: high-performance graphics processing units. GPUs. These chips are the brain of every AI model, and they're incredibly hard to manufacture. Nvidia basically has them locked down, so what happened was predictable. All this venture capital looking for AI companies to fund ran into a wall. There weren't enough GPUs to go around, which meant the AI startups couldn't train their models fast enough, which meant they couldn't prove they were worth the money. So the money had to go somewhere else. Some of it started flowing into compute providers. Companies like CoreWeave and Nebius that would buy tons of Nvidia GPUs and then rent access to them on the cloud. Kind of like how Amazon Web Services rents out servers. Suddenly, compute became a separate business. Investors could back compute providers instead of waiting for an AI startup to maybe make it. And that's when the circle started forming. So now let's actually map out how the circle works. Here's the basic flow. Venture capital firms raise mega funds, sometimes $5 to $20 billion each. They take that money and invest in AI companies like OpenAI, Anthropic, startups building models and AI software. But they also invest in compute providers like CoreWeave and Nebius. Here's the clever bit. These compute providers buy their chips from Nvidia. Some venture firms are also investors in Nvidia, so you've got the same limited partners funding both the companies buying chips and the company selling chips. That's the first link in the circle. Now the AI startups need computing power to train their models, so they buy it from CoreWeave or Nebius, the same compute companies their investors funded. Money flows out of the startup into the compute provider. The compute provider takes that money and buys more Nvidia GPUs. More chips means more Nvidia revenue. If those venture capital firms are invested in Nvidia, they profit. And round it goes. The really fascinating part is that this isn't some hidden conspiracy. It's not illegal or even particularly secretive. Every venture capital firm in Silicon Valley will openly tell you they are backing multiple layers of the AI stack: AI model companies and infrastructure companies and chip makers. They think they are hedging their bets. What they are actually doing is creating a system where they profit regardless of which specific company wins. Let's look at a real example to make this concrete. Sequoia Capital is one of the world's most famous venture firms. They've invested billions in OpenAI. They're also investors in CoreWeave, which is one of the major GPU cloud providers. And when you look at their portfolio, they've backed tons of other AI companies that are now CoreWeave customers. So Sequoia profits when those companies use more compute. CoreWeave profits when it sells that compute. And CoreWeave profits when it buys more Nvidia GPUs. Meanwhile, Benchmark and other funds back Anthropic, one of OpenAI's biggest competitors. Anthropic also uses compute providers to run their models. They're burning through tens of millions of dollars every month just to rent GPU time from companies like CoreWeave and Lambda Labs. So money that venture firms raised from their investors ends up flowing directly to GPU vendors. Now think about what this means. If you're a venture capitalist, you're not just betting on one company winning. You're betting on the entire ecosystem. You're making money no matter which AI company becomes the next big thing, as long as it's using GPUs. And that creates a perverse incentive. The system rewards you for making sure as many AI companies as possible are burning through GPUs as fast as possible. It's not a problem if your portfolio companies are wasteful with compute. It's actually good for you. This is where circular financing gets really different from how venture capital worked even 5 years ago. In a traditional tech boom, venture firms would raise a fund and then make individual bets on companies they thought would win. The best investor was the one who picked the winning horse. But in this circular GPU economy, the best investors aren't trying to pick winners anymore. They're trying to make sure everyone's playing in the same game, the game where you need massive amounts of expensive compute. It's the difference between playing poker and dealing poker. In poker, you want to beat the other players. In dealing poker, you make money every single time anyone plays a hand, regardless of who wins. That's what venture capital has shifted toward. They're not betting on OpenAI beating Anthropic anymore. They're betting on both of them needing expensive GPU compute forever. This also means that venture firms are less interested in funding capital-efficient AI startups. Why would you want a startup that needs $100,000 to train a model when you could back one that needs $100 million? One burns more compute. One makes you more money from the circle. The incentive structure has completely flipped from find the best technology to maximize GPU consumption across the entire ecosystem. So what are the implications of this? Well, the good news is obvious. This circular system efficiently funnels resources into AI infrastructure. We're getting more compute capacity, more data centers, more investments in chips and cooling technology. The GPU boom is driving genuine innovation in hardware. Nvidia's engineering is getting better. CoreWeave and Nebius are building world-class infrastructure. If you believe AI is transformative, then this system is great. It's pushing capital toward the infrastructure we need. But here's the dangerous part. Circular systems are stable until they break. And when they break fast. What happens if AI models suddenly get more efficient? What if someone figures out how to get similar performance with fewer GPUs? The entire ecosystem collapses because it's built on the assumption that GPU consumption keeps growing forever. Or what if there's a recession and venture capital dries up? Suddenly, there's less money to fund new AI companies. Those companies can't afford compute. Compute providers lose customers, Nvidia loses revenue, and the circle snaps. The other big risk is power concentration. Nvidia becomes more powerful because they're in every link of the chain. Venture capital firms become more powerful because they control which companies get funded. And individual AI companies become less important because they are just nodes in a bigger network. That sounds efficient on paper. In practice, it might mean less diversity, less actual competition, and more outcomes decided by financial engineering rather than who builds the best technology. If you're an investor and you want to spot circular financing yourself, here's what to look for. First, follow the money backwards. When a company raises funding, look at who the investors are. Then look at that investor's other portfolio companies. Do they have customers in your company's industry? Are any of them buying from each other? That's the first red flag. Second, look at the customer concentration. If a compute provider like CoreWeave makes most of its money from a handful of AI startups, and those AI startups are all funded by the same venture capital firms, you've found a circle. Third, look for perverse incentives. Is this investor rewarded if their portfolio company grows, or are they rewarded if it burns money? There's a difference. In a healthy startup ecosystem, investors want companies to be capital efficient. In a circular system, investors want the opposite. They want companies to spend as much as possible. Finally, ask yourself whether this system depends on one thing staying true forever. In this case, It's the assumption that GPU consumption must grow forever. If you can imagine a world where that assumption breaks, you've found the weakness. The beautiful thing about spotting circular systems is that once you see the pattern, you can't unsee it. And that's what's happening right now in the AI boom. More and more investors are starting to notice. Here's what matters. The GPU boom is real. Investments in AI infrastructure are genuinely transformative. Companies like Nvidia, CoreWeave, and Nebius are doing important work. But the circular financing structure is precarious. It works beautifully as long as everyone plays the game. The moment the game changes, models get more efficient, capital dries up, some other shock, the circle could snap. That doesn't mean it will. It's possible we're in a genuine AI boom that'll run for decades, and venture capitalists are just being smart by diversifying across all stack layers. The infrastructure investments are real. The innovation is real. Maybe the circle is the efficient way to fund transformation. But here's what's important. You should know the circle exists. Nvidia's power comes not just from great chips, but from being woven into every financial transaction in this ecosystem. Venture capitalists are optimizing for GPU consumption, not necessarily for the best technology. Watch for signs the system might strain. If GPU utilization stalls, if startups get more capital efficient instead of capital hungry, if venture funding dries up, those are early warnings the circle might break. And until it does, the GPU boom rolls on, fueled by one of the most elegant financial structures ever built. Follow for daily AI news.